say you said that, they're buying 10 500K residential properties, $80,000 to $100,000 wage. How would they structure it in terms of buying in personal names, trusts, companies, whatnot, to get to 5, I guess, from zero?
Yeah. Look, realistically, if they're on 80 to 100,000, they're not going to be able to buy 10 properties at $500,000 each. It's not. They're going to have to get smarter with what they buy to do that, because the average. And look, it depends also where they buy. This is where they need people like yourselves, because if they're PAYG, they've got some restrictions in place to grow a big portfolio, and so they have to be really smart with every step. They've got to be smart with how they set their finance up. They've got to be super smart with what they buy and where they buy, and whether it's going to be resi or commercial. Because whether it's residential at the moment, we can leverage a lot higher. So for the average person, we can leverage to 95% with residential, and we can leverage, depending on the sort of person and what they're buying, anywhere between 80 to 100% for commercial. And so leverage is there depending on what they're buying and where. And if they've got a price point at the moment, you say under $500,000, they're going to be restricted also where they can buy. And so location is important. And Sam, as a valuer, know all about this, that the valuers have different perspectives about where they're buying in Australia, and some locations aren't what we call a metropolitan sort of top location for banks. And so as you're going more regional or smaller location, the banks can bring in restrictions. And it's not just the banking restrictions that come into it, it's also the valuation restrictions. Because let's say that someone's buying in Upper Whoop Whoop in Queensland, and there's 4,000 people there. The yield on the property or the rent might be 12%, which is phenomenal. Everyone wants 12% in their portfolio. But there might only be one valuer who services that area, who goes there on a Tuesday each month. And so there's less options we've got to really maximise the value of that property, because you've only got one valuer who's going to go there. And so that is going to partly restrict the ability to grow, because if that valuer is having an off day, or they don't believe in what you've done to the property, all of a sudden your $400,000 property is now $420, instead of potentially being in another area where we've got 4 or 5 valuers that we can play off against each other. And instead of one guy maybe going at 420, another guy's having a great day, or maybe he doesn't put the effort in and he's at 500. So Sam would know this, and this is what we do all the time, is we get at least 5 valuations on every property we value for a client, because the difference in valuations is huge. So that's just one thing we need to take into account. But as a PAYG person, what you started to do, Jared, is ideal. Is that you've obviously been exposed to structures from day one. And so just because someone's PAYG doesn't mean they can't buy in a company and trust. And it does partly come down to cash flow, in my opinion. Is that a good thing about buying in a structure is that not taking your situation into account, but if someone did have a positively or neutrally geared property, putting it in your own name, there's not going to be any tax benefits. Especially at the moment, if the interest rates are basically at the top of the peak of the market now, and you're not really negatively geared, you're probably never going to be in the next 10 to 20 years potentially, because hopefully the rates are going to start to come down over the next couple of years, and we'll see what happens after that. So if you're not really negatively geared now, you probably won't be in the next cycle anyway over the next 7 or 8 years. So that way, if you're not really negatively geared, there's not a huge reason to have it in your own name, because by putting assets in a company and trust, there's a level of what we call asset protection in doing that as well. Because if you ever got sued, well, because the property's owned in a company and trust, it's not you, it's a separate legal entity, so they can't get at it, which is pretty cool. It doesn't protect you if you get divorced, so I always get that. Oh, can I put it over here so then my partner can't get hold of it? No. Everything's shared, they say all of that, but it's more from an asset protection, it's beneficial. So what I would say is, yes, we want to look at the cash flow of the property. If it's not going to be any negative gearing at all, well, let's look at a company and trust, how that could benefit you. And with the second property, you said your one was potentially, there was a bit of negative gearing. What I'd be doing is looking at, okay, how much negative gearing is there? Is it a meaningful amount? If it's not, I probably would have put that in the first trust, because the positive cash flow from the first one would have offset the negative cash flow potentially from the second one. That way, the trust is still trading positively. And what that means from a serviceability aspect is that I have lenders where we can isolate that structure on its side over here, and we don't need to take into account for gearing for the next one. So when we look at growing people's portfolio, we can grow portfolios in your own name. We can grow portfolios in your and your partner's name, or just your partner's name. We can grow portfolios in one company and trust. But then, as I'll mention in a minute, we can set up a second company and trust as well, which grows separately, which I'll talk about. And then you can also grow it in your superannuation environment potentially as well. So we can have all these streams going at one time. So people think, I want to grow 5 properties over 10 years. You could probably get 5 properties in 4 years. Because as we all know in property, the benefit of property is the capital growth over time. And to get capital growth and the whole compounding interest of it, well, compound interest is the backbone, but compound interest is based on time. So the quicker we can get our assets and then let them grow over a long period of time, the much more money we're going to get. And the people sort of don't always twig. They want to they think they're being conservative. I'll get one this year, then in 3 years I'll get another one, and they add it all out. But really, the best way to make money is to get as many as you can, as quickly as you can, and then be able to hold them and just sit back and reap the rewards over a long period of time. And then you make a fortune. But a lot of people sort of don't have that mindset.
I love that mindset. And I love that explanation on, buying in trusts, buying as soon as you can to grow your portfolio as fast as you can. Because, you could buy maybe 5 in 4 years and then do nothing. Or after that, the 5 that you bought in the 4 years, you could grow your portfolio a lot faster than what you could if you were being conservative as well. So you can either choose to chill or you can choose to grow as well.